Current tariffs, they are very similar to the Boston Tea Party incident of 18th century, where American colonists they had dumped chests of tea into the harbor to protest against the unilateral taxes that were imposed by the British government. And this tea that was originated in India actually. And it's how ironical that the tables have turned that US has imposed unilateral tariffs across the world. But in the modern world, we'll resolve it and navigate through these tariffs by bilateral trade agreements. We won't be dumping anything into the sea at this time.
India did not benefit anything out of this. We feel that it is well positioned both from a diplomacy point of view, from a capital point of view, from an availability of manpower point of view. And don't forget, India is among the fastest growing in this third bucket of countries that I talked about. The MNCs in US, in Europe are showing interest that they need to invest in India for some of the basic supplies.
You use the term multipolar here, and definitely we are living in a world where no single country or no single region can dominate the overall manufacturing supply chain. What are the measures that are needed for revival of the entire manufacturing sector in India?
World has to grow and new capacities have to be created. India will play a major role. Eventually, government is ready to say that enough is enough, that we need to manufacture these. Even if it is slightly higher price also still fine. But we have to manufacture these in India because otherwise the very fact of job creation in India is not going to happen.
Market Thalaivas brought to you by Sundaram Alternates.
Hello everyone, I'm Sandeep Tulsiyan, Fund Manager at Sundaram Alternates, and I welcome you all to another insightful episode of Market Thalaivas, where we do deep dive into some of the most important current topics and their implications on stock markets at large. Today, we are joined by Mr. Madanagopal Ramu. He's head equities at Sundaram Alternates to discuss today's topic, that is the tariff tightrope, where we will be discussing the implications of US tariffs on global trade. Hi, Madan.
Hi Sandeep.
Okay, so I just want to remind you of one of the incidents that I was reading about over the weekend. That the
Okay.
current tariffs, they are very similar to the Boston Tea Party incident of 18th century, where American colonists they had dumped chests of tea into the harbor to protest against the unilateral taxes that were imposed by the British government.
Okay.
And this tea that was originated in India actually. And it's how ironical that the tables have turned that US has imposed unilateral tariffs across the world. But in the modern world, we'll resolve it and navigate through these tariffs by bilateral trade agreements. We won't be dumping anything into the sea at this time. With that, I would like to start with the first question. So, recently I went through your note, and you seem to be very positive on the impact of these tariffs on India. So, I want to understand this in detail. What is different this time versus Trump tariff 1.0? And with the current policy changes and India's positioning in the past few years, how these tariffs will impact India and improve its positioning in the global trade today?
Sure, Sandeep. I think tariff per se is not great news. So let's be very clear on that. As such, tariffs or change in tariffs are never good for global trade. But what is happening clearly is, if you go step back a little bit and then observe what is US and China getting into. US is clearly getting into this phase of de-risking supply chains for for the imports that they are doing out of China. So they are clearly in this path of de-risking the supply chain, and they started it in the first term of Mr. Trump, and they introduced several tariffs on various Chinese products. And Mr. Biden continued it. It is not about Mr. Trump alone doing it. It continued even the Democrats when they were running the presidential. Followed now with the Trump tariff 2 coming through, it has become much more bigger and much more larger in terms of the impact it can have. So our thought process, our observation on this is that the US de-risking strategy is on, and it is only becoming bigger and bigger. And now, if you step back and see what happened with in the Trump tariff 1 period, India was not actually well prepared for the opportunity at all. Roughly, China exported around $500 billion during the during the Trump's first term. If you see in that period, post that in last decade, almost $200 billion increase in Asian countries export to US has come, and China's export to US has come down from around $500 billion to $440 billion, something like 40 60 billion dollar reduced in a 10-year period, while you would have expected it to go up by some 30 40%. So clearly there is a shift that has happened out of China to other Asian countries, and India did not benefit anything out of this, and India's share of global trade has actually come down in this period, to say, in the merchandise side. And clearly shows that India was not well prepared to make use of this opportunity. There are 4 5 really important points that you can discuss when you think through. First is we were just introducing GST, which is a, I think, is a basic requirement for any MNC to set up its shop in India. Uh, I don't think any MNC will be happy to deal with the 24 26 states in India from a tax jurisdiction point of view. Therefore, implementing GST was a basic requirement. Even that was done only in 2017 period. So clearly shows that India was not well prepared at all during the Trump's first term to make use of this opportunity. Second, the we did not have incentive schemes like production link incentive that we are giving today to electronics and chemical companies, auto companies, engineering companies to attract foreign companies to set up shop in India. Third, even the leverage position of corporates were not in a great situation, right? If you go back in before COVID, India was still struggling with a lot of NPA in the PSU banks, and therefore corporate capex was looking very difficult to take off, even if it is there. Second, you also had a situation that the capital was not available with PSU banks at all, and the NPA cycle was going through worse in that period. Now we are in a completely different situation. We are in a situation that banks are fully funded, capital is quite available. All these PSU banks have now a good return generation. They almost run a 15% ROE sort of a business right now. So the capital is available from a banking perspective. And importantly, before COVID, the market cap to GDP of India was around probably less than one time, zero point 0.7, something like that. Today, it has touched almost like 1.5 times. And particularly, this has expanded in the mid and small cap space. So the capital availability, which was always an issue for India, it has changed dramatically. Today, the a mid corporate, small size corporate in India who is looking to get a project done for an international company for an outsourcing, either in the chemical space or in the electronic space. Today, they don't need to actually go for debt straight away. They can actually dilute some part of their equity because their valuations have gone up from 15 20 times multiple to almost like 30 40 times. Some of the EMS companies are even trading at 80 90 times. So today, equity is the cheapest capital for the mid and small corporates in India. So what I feel is, I think the India's position from both from a policy perspective and the Indian corporates perspective from both debt and the equity availability at a cheaper rate and availability itself has dramatically changed in the last 10 years or so. So India is now well positioned, and given what is happening globally, there is a multipolar world that we are talking about. See, US is almost like $40 trillion close to economy. China is almost closer to a $20 trillion economy, and you have n number of another 7 8 countries like starting with Germany to France to Japan to India. We are all around $4 trillion sort of economy, right? So I think there is a third world that is polar, that is getting created, and it will change the way global trade happens. And we feel that India is well positioned both from a diplomacy point of view, from a capital point of view, from an availability of manpower point of view. And don't forget, India is among the fastest growing in this third bucket of countries that I talked about. India is $4 trillion and it is growing at almost like 11% nominal GDP growth rate. And if that were to happen, India will touch $7 to $8 trillion in 6 years time period. $7 to $8 trillion. I think India's domestic market itself becomes very attractive for many MNCs. So I think it is very clear that if you are investing in India, you are investing not only for exports but also for India, because India is a fast growing economy, sizable economy right now. So in that context, I think there are anecdotal evidence right now that the MNCs in US, in Europe, are showing interest that they need to invest in India for some of the basic supplies and also some high tech products. Particularly, I see electronic manufacturing, chemicals, pharma, auto anks. These areas, I think India's position is well established, and we have very good manpower here. Uh, and I think India should get a decent share in the next 10 years in these markets from a global trade perspective. I'm not very sure about how India will get position on textiles and all, which has become like a very low skilled sort of industries where our competitiveness is properly eroded by other countries in the Asian region. But when it comes to some of the slightly skilled sort of sectors like auto engineering, pharma, CDMO, agrochemical sector, specialty chemical sector, auto engineering, as I highlighted, I think these areas, I think India's positioning is good. Now capital is available. Now market cap is very good. So some equity dilution can be done to raise money and then increase the number of projects that you can do. And I think that is putting India in a good position, in a sweet spot, I would say, to claim some market share out of the global trade, which India was always missing for so many years. So that's what I would like to mention.
Interesting. I think you use the term multipolar here, and definitely we are living in a world where no single country or no single region can dominate the overall manufacturing supply chain. Which reminds me of one anecdote that I would like to share with you. There's this economist called Leonard Reed. A few years back, he explained that through an essay on a pencil, that there is not a single person or a company in the world who knows how to manufacture the pencil entirely on its own. The cedar wood comes from California, the graphite
Okay.
comes from some mines in South Africa, the rubber at the back is made from oil manufactured in Indonesia, and the paint on top of it, the metal crimp, everything comes from specialist manufacturers in different countries. Now, when we extrapolate this to more complex products like an aircraft or a mobile phone or a laptop or a car, we realize that the modern day supply chains are much more complex than manufacturing a pencil. And high tariffs on some of these supplies can cause significant disruptions, where definitely you share a view that India should benefit. So, on broader manufacturing sector per se, what is the overall outlook? Because we see that manufacturing has been a growth problem for India per se, and it has lagged the other Asian peers, as you shared in the data points in the earlier question. So, what should be the policy changes that the government should make other than the overall Make in India that it's trying to push? And in your view, what are the measures that are needed for revival of the entire manufacturing sector in India?
See, manufacturing sector, as we always talked about, I think there are many constraints for India to be successful on the manufacturing side. Inflation itself has been an issue, and the high interest rate, cost of capital has been an issue. And as we discussed now, inflation is moderating, and from an interest rate perspective, also, I think availability of capital on the equity side solves a lot of this problem, at least in the medium term perspective. So a lot of policy initiatives that have been taken by the government from an PLI incentive, capital subsidy, already has been taken. I think we currently have a very good single window clearance system also to enable a quicker setup of shop in India. So a lot of policy related changes have been done. That's what I said. It should have been done much earlier, but thankfully it has been done in the last 7 8 years time period, from the last decade point of view. If you see, a lot of it has been already done. The problem is that when we got into this, we had a COVID, and then followed by which we had a global recovery, and we benefited also. When you saw Chinese game supply chain getting impacted, a lot of sourcing happened from India. So there is a clear indication that if the world has to grow, and new capacities have to be created. India will play a major role, and we have now created a good platform for global companies to come and invest. And they don't need to put capital. If you look at, they have to invest in Cambodia, Vietnam, Thailand, capital has to be brought in by the MNCs themselves. Today, you're not in that situation. If you're going to invest in India, you will find a partner in India who is able to bring that capital on table to you. So that's something puts India's in a slightly advantageous position compared to other countries. And labor, I did not mention about labor and land availability. When we are talking about completely, not completely, a reasonable shift out of China from a de-risking perspective, I think you need a lot more labor and a lot more skilled labor, and also more land for you to work with the infrastructure, right? So both this will put India in a different definite advantage compared to the other countries in the Asian region, other countries in the Asian region. But the point is, most importantly, domestic market is becoming very, very large for India. And in this case, to support the domestic manufacturers, Government of India has been pushing for Make in India by literally stopping import for majority of the products that can be manufactured in India. And this policy has been something which has been very consistent right from Mr. Modi's first term, and it is now becoming much more, it is a push factor, right? So corporates are continuously pushed and questioned why they are importing certain components from China, which if can be manufactured in India. And if government is supporting you through PLI scheme and all, why don't you do it? Initially, obviously, the ROC is going to be lower, but eventually government is ready to say that enough is enough, that we need to manufacture these, even if it is slightly higher price also still fine, but we have to manufacture these in India, because otherwise the very fact of job creation in India is not going to happen. So that policy seems to be active. I think you also know, we have tracked the capital goods space for so many years, and the power sector used to be a victim of Chinese import. And there was a good demand that got created in power transmission equipment in somewhere like 2010 cycle, but Indian companies did not benefit at all. The reason is we were importing happily from China, and that was at a significant discount to the Indian companies. And the margin compression, loss, all this led to many of the Indian companies closing their shop at that point of time. Now you see the revival is happening in power sector, in power equipment, but the only supplies are domestic manufacturers. And all these companies which were making losses are now turned profitable. And now they can invest in the capacity. Same thing can happen in electronic manufacturing, same thing can happen in auto manufacturing. I think to an extent we need to protect our domestic industry, domestic corporates. Only then they will commit the capex for the next leg of growth. That is also happening right now. Although this is not well talked about, many of the discussion keeps happening on Make in India. But the underlying is, you can have Make in India, but unless you make them profitable, a reasonably profitable investment, I think private sector in India is not going to commit capex. So that situation is also now there. Therefore, combined with this new world order, where a multipolar world will create an opportunity for India to gain some market share in the global trade, India will also increase its market share, manufacturing market share, for the domestic consumption also. All this put together, I feel, we have done some numbers. We feel that India, if looking at what Asian countries have done in the last 10 years, they have grabbed almost $200 billion of opportunities. If India can do even 50% of that in the next 10 years, and then if India can also reduce its dependency on China and Vietnam and all these countries from an import perspective up to $100 billion, the $200 billion has its own multiplier impact on Indian economy. All this put together, we roughly can see that Indian economy can grow at least 50 bips minimum to somewhere like even 100 bips compared to where we are right now. So right now we are talking about anywhere between 5.5-6% sort of a GDP, real GDP growth rate, and 10% sort of a nominal GDP growth rate. We can actually expect that we can move up to something like 6.5-7% sort of a real GDP, and 10% GDP, nominal GDP moving to something like 11% nominal GDP. And that's a big number, right? 11% nominal GDP Your large cap earnings growth might move somewhere closer to 10 to 12%. Your mid and small cap sectors which are participating in India growth story, the growth can actually in many of those segments, if not all the mid cap sectors, in many of the sectors which are participating in this India growth story, I think there the earnings growth or revenue growth can actually go up even up to 15 to 20%, and earnings growth can be above 20% in the coming decade. That puts India's opportunity in a very good shape from an investment perspective for global investors. And mind you, all this we are talking at a time when noise levels are very high because of tariff and all this, and valuations have seen a reasonable correction. And also, you also had a situation that foreign holding in India has come down significantly. So we are right now in a very good positioning when we are talking about how India is making use of the emerging opportunity in the new world order, and simultaneously the foreign investment in India in the equities are at a lower level. So you can only be positive if the domestic flows stabilize, even if they stabilize, if not increase, stabilize at the current levels, and if foreign money comes, it puts Indian market in a very good context from an investment perspective.
Sure. No, no, those are very interesting thoughts, Madan. And see, the general market recommendation right now, the overarching view is that one should move their portfolio more towards large cap, as the
Hmm.
valuations seem very rich in the small and mid cap space. But when we look at our portfolio, it's skewed more towards mid and small cap. So, would you like to address some of these investor concerns and why you have a
Sure, sure.
contrarian view here in terms of a higher allocation towards mid and small caps?
My problem with the large cap is earnings, and it is not cheap as people try to put it out. First point is, I think valuation is a function of earnings, right? Earnings growth, cash flow growth, and large caps earnings growth for the 9 month period of this year is 5%. I think in this quarter also, I think they are around 6%. So we are talking about single digit growth at this point of time. And the reason why Nifty 50 suffers on earnings growth, the reason is many of the traditional sectors form part of the Nifty 50. So if you are playing large cap in India, you run a risk of playing those sectors which are not really the representation of India's growth story. And therefore the earnings growth being muted, and therefore currently people talking about a 20 times multiple is cheap for large caps in India. If you remove some of the traditional sectors which always trade at lower valuations, right? If you take banks, they generally trade around 10 to 15 times multiple, 1 year forward P multiple. That's the maximum any banks trade globally as well as in India. Also, you're talking about oil and gas, metal sectors. They generally trade at EV a bit of 5 6 times, PE of around 10 12 times. I don't think beyond that they any commodity companies trade. And you have a situation of and if you look at telecom, generally trades again at EV a bit of around 8 9 times, sort of multiple PE of around 12 15 times. So if you take all this out of the picture, Nifty is also trading at almost like 25 times. It is not very cheap compared to mid cap. Mid cap today has come down to a reasonable valuation after the recent fall that has happened. It is currently 1 year forward, I think 28 times, something like that. So mid caps are not at a significant premium. They are at a premium, but they are not at a significant premium. And small large caps are not as cheap as what you think. And small cap is a large universe. So here talking about the index multiple itself is a mistake in my opinion. And same with mid cap also. But still, if you look at, generally, we have gone into this very safe discussion mode every time when we talk about, and it's a typical mutual fund sort of a discussion: large cap, mid cap, small cap. I think if you are going to be very specific, sector specific, and stock specific, and if you are getting them at a reasonable valuation, a mid cap portfolio of around 30 times, but with a growth rate of around 20%, which is what we have created in our portfolio, that looks much more attractive to me than buying Nifty at around say 20 21 times with a return expectation of around 10 12%. So we first point is, I think if you want to play India growth story, you need to play sectors, and those sectors are mostly in not in Nifty 50 majorly. They have some representation, but they majorly miss out on this growth sectors. Second, I think valuations as it is being made out, it is not very cheap in Nifty. if you remove the traditional sectors which generally trade at a lower PE, while the gap is still there, but it is not as big as what people are making out between the mid cap, small cap versus the large cap argument. Now, coming to sectors that we like within the mid and small cap, I think sectors like if India's growth story, from whatever we discussed, that if India makes use of this current opportunity of the new world order and then increases its share of the global manufacturing, we are talking about a 11% sort of a nominal GDP. We can easily build a 25-30 stock portfolio with a 20% plus earnings growth at somewhere like 28 times, 30 times multiple. And that's a reasonable valuation. That's like almost closer to 1.2, 1.3 times sort of a PEG ratio, which is not very costly. Although PEG ratio is not a scientifically right methodology, but I'm just putting in the context. When you look at Nifty, it for a 10% earnings growth rate, it is trading at 20 times, which is like almost like 0.5 times. Today we are talking about a 20 times 20%, 25% earnings growth rate for us, and almost like 28%, 28 times sort of a multiple. We are not talking about, we are actually looking cheaper compared to Nifty's valuation from a big point of view. So I think it's all about selecting the right stocks and the right sectors and investing into them when it comes to mid and small cap. If I think we need to get out of this comfort zone of just talking about large cap, mid cap, and small cap. Large cap definitely lacks attractiveness from an earnings point of view, and in mid and small cap, if you can avoid over exaggerated stories and overvalued zones, there are many zones which have become attractive from a valuation perspective. And I think NBFC sector, consumer discretionary sector, and manufacturing sector post the recent correction, capital goods sector post the recent correction. I think these are valuations are not super rich. They are reasonable, and earnings growth is pretty impressive compared to the Nifty. And that is the reason why we feel this general thesis that is going on in the market that move to large cap, I think it will not add value. Rather, you should be getting into mid and small cap, and we see reasonable interest coming in mid and small cap. If you're stock specific, please don't take this as a recommendation for a portfolio with 70-80 stocks of mid caps or 70-80 stocks of small cap. I think tail risk is going to hurt those very highly diversified portfolios. The opportunities are in specific pockets, and if you run a concentrated portfolio targeting those specific pockets, then I think that's a zone that I think will create more value to the investors compared to talking about moving to large cap, mid cap, and small cap sort of a discussion. I think selective set of stocks in large cap, mid cap, and small cap, and putting a 25-30 stock portfolio. I think even if it is a slightly higher premium to the Nifty, but with a 20 to 25% sort of an earnings growth rate, I think that's a zone that we would like to be, and there are good opportunities for that. And given the noise that has happened on tariff war, followed by India Pakistan war, and FIs exiting from India, now FIs are coming back and they are looking for opportunities in that space alone. And I think many of this mid and small cap is seeing buying from FIs right now. So I feel investor will make more money by being in stock specific across three cap curves rather than looking at each cap curve on an isolated basis. So that's a point that I would like to make.
No, that's clear enough, and I hope this contrarian view continues to add alpha to our portfolios and generate more returns for them. So, with
Sure.
this, we'd like to conclude this episode. Thank you, everyone, and I hope today's session did much more value at you, and you learned something new from this episode of Market Thalaivas. Thank you. Thank
Thank
you,
you.
Madan.
Market Thalaivas brought to you by Sundaram Alternates.